Thank you very much. Morning, everyone. Hope you enjoyed the coffee break. I'd like to open the session by sharing with you some perspectives on mining in the Far East in Russia. So in 2013, Russia ranked as third worldwide in terms of foreign direct investment, with about 94 billion investment. Second, so they ranked third only behind China and the USA. This FDI was concentrated mainly in West and Central Russia, with Moscow and St. Petersburg regions making up 65% of the total FDI. The total in the eastern regions, the Far East and Siberia, totaled only 8%, which is extremely low. This region is experiencing strong regional industrialization, mainly because of the vast amount of natural resources that they have, and also their strategic location in terms of their partnership with China, which, as we know, is the biggest consumer of natural resources of the world, is likely to enable them to grow further. So the Russian Far East is very rich in traditional commodities. It's got vast resources of iron ore, coal, zinc, bauxite, and other bulk natural resources. But also, and interestingly, in less traditional commodities that we call China 2.0 commodities. So these are commodities that have more advanced applications, such as electronics, high-tech, and other high-tech industries. I'm mentioning here tungsten, titanium, PGM, things like rare earths as well. And these are focused mainly in the southeasternmost region of Russia, which, strategically important, has a very advantageous logistics cost, which will enable them to explore the Chinese market. So from an investment perspective, differentiating between commodities 1.0 and 2.0 requires an in-depth industry demand analysis, so a bottom-up analysis of what are the main consumption segments for each one. So if we look here, we've got a matrix of all the different commodities, so traditional and what we call 2.0, with the different segments of application. And if I've selected here a portfolio of commodities for which Russia has an extremely strong resource base, and for things like tungsten, things like tin, things like rare earth materials, they've got the market fundamentals for these commodities are actually very strong. So we're expecting to have a strong demand outlook and also either tightening supply or a slower growth of supply than demand, which will give us an upside, a strong price forecast. From a geopolitical perspective, these 2.0 China commodities also appear to have a positive outlook. So if we analyze the knock-on effects of the Western sanctions, we observe two different things. So firstly, we've got a potential decrease of the exports from Russia coming into Western Europe, which means that the Chinese and Asian markets will come more to the fore for these commodities. And secondly, there'll be more difficulty in finding financing coming from Europe, which again will increase the reliance, or the opportunity rather, coming from China. So in the longer term, this will cause two different things. Firstly, it will be a restructuring of commodity flows, shifting from Europe in favor of Asia, so China and also the other Asian markets such as Taiwan, who are strong consumers of rare earths, for instance. And secondly, internally, Russia will have a more self-sustainable economy with more support coming at a federal level and also at a regional level. So Russia has already come up with a plan to put a lot of investment into the Russian Far East, and we're expected to see a threefold increase in investment into the region, reaching about $2 billion by 2016. And this will be mainly into infrastructure, rail, roads, airports, all logistics infrastructure, but also more tangible things such as the development of human capital, growth of skills and competencies, and a lot more advanced support from the Russian state. So there are already some companies that are involved in partnerships in the Russian Far East with the Russian government, and they're experiencing some strong support from them that comes in many forms. So we're looking at advantageous tax breaks, easing of customs regime, construction approvals, and overall encouragement of mining project development. For example, in September 2014, EURASIA announced a 0% profit tax rate for the development of mining greenfields for the first 5 years. So at Bryanston, we've conducted already several panel discussions to identify what would be the key levers for success for the development of the Far East. And we've identified, I guess, three really stand out. So firstly is human resources. Are there enough functional specialists, production personnel, and key skills to enable a quick ramp-up of mining assets in the Far East? Secondly, the setup of a financial infrastructure in the model of what's going on in Canada, so the setup of an environment that's favourable for investors and encouraging investment to come in by subsidising exploration works. And lastly, the cooperation with China, which for us is the most important factor. So this comes in on collaborating on investments, sales channels, equipment usage, and everything that can push forward the commercial partnership. Just a few words about Bryanston. So we have three major pillars to our business. We're active in investment advisory, principal investments, and also in management consulting across different commodities, specializing in base metals. We've got a global presence with about 100 professionals worldwide, spread across 12 offices, and notably we're already present in Moscow and in Shanghai. Our key competencies range across quite a wide spectrum. We conduct bottom-up market balances, trade flow analyses, pricing and cost analyses for all key commodities. And finally, we combine expertise in private equity and in mining, which enables us to be what we call a one-stop shop for our investment partners. And we support at every single level of the project life cycle. And we also co-invest quite often with our partners, which gives us an integrated approach to investments. That's it. Thanks for your attention.